All right, good morning, everyone. This is, of course, the educational series that we're going through different parts of the Boring Bull website to kind of give you an idea of what each component does, what each page does, and hopefully generate some ideas for further advancements and further features. As always, we kind of start off the Boring Bull is a website that educates the power of kind of quant investing. Algo trading is also a term that's commonly used. And we use a variety of financial, technical, and macro indicators. At a high level, basically what we're trying to do is we're trying to take a collection of financial information. It could be stock prices, bond prices, it can be macro indicators. We add that mathematics. It could be simple as moving averages or advanced statistics or even machine learning. And then we add that technology, computing power. And by bringing those three areas together, we create a model. And then that model kind of helps us dictate of how we can leverage it in the stock market. That's kind of what we do. So I always want to kind of open up with that page, just kind of get level set with what we do. Today we're going to be talking about the quote bear tracker. That is located on the dashboard menu. It's the fourth option. And so let's get into it. It's simple. It's simple and straightforward, at least from a visual display perspective. It's pretty much all you're going to see on that web page is, of course, a picture of the bear, and but there's a little progress bar there. And basically the idea is that the further left we are, there is no bear signs. There's no indication of a bear market or a correction. However, of course, obviously, if we're on the other side, where it says the kind of the watch out, again from a progress bar that goes up to 100%, then obviously there's a lot of problems happening. And so let's see how we actually build that percentage. It's kind of an assembly of a different collection of indicators. There's certainly technical indicator, and we'll show an example of each one of these here in a second. We then take a series of macro indicators, and then we take what we're going to call visual indicators, and we kind of combine all those in place. And since this is a bear tracker, you can see there's a little more weight given to the macro indicator than the other two. But still, the influence of the technical and the visual do come into play. So let's look at what an example of one technical indicator might look like. The one we kind of use frequently is the volatility. We call that the daily VIX. And you can see here is this is going from a picture I took of 817 through 1020. The main thing you can see here is that we're staying below the waterline, 24. Generally speaking, in our model, 24 is kind of the pivot point. Anything above that, it's very volatile. Volatility usually brings lower prices. Low volatility brings in kind of a consistent growth. And so for us, we kind of label that as anything below the watermark as good or a bull market indicator. But anything above that, we would tend to indicate that as a bear market. So in one box, we might bring this indicator in and determine whether it's a bull or a bear, and that gets added to the equation. So that's an example of a technical indicator and how we might measure it, and then how it might apply to the progress bar that you saw. Here's an example of maybe a macro indicator. How does that get brought into it? So in this case, we're looking at consumer price index and the gross domestic product, GDP, and the CPI. I'll focus attention here in quad 2, which is your upper right hand. Think about that for a moment. We've got a growing economy is expanding, our inflation is going up because we can't seem to get prices high enough to slow it down. It's overheating. This, of course, is very good for businesses and stocks. Then as we come down into 4, we've got the opposite problem, right? We've got a low GDP. That means the economy is contracting. We have low CPI. Prices are coming down. They can't come down fast enough to generate the economy, to trigger it, to reverse it, to heat it up, however you want to say it. And that puts us in what we call 4, quad 4. Now our model takes into account what we call 4-4. So you have to be in the fourth quadrant, and then if you're in the fourth of the fourth, again, there's a little fractal stuff here, that's just death. So you can see that if, depending on which quad we're in, or in our case 4-4, that could have an impact on that progress bar. So if we happen to be in 4-4, it's going to shift it, or put a heavy weight, if you will, to shift that thing further to the right. Obviously, if we're in quad 2, it'll shift it a little more to the right. So here's an example of how a macro indicator can make our bear tracker slide back and forth. Would have an influence. And again, these macro indicators, and this is just one we're showing here. They're heavily weighted, so they're the 50% weight that we have. Now, I mentioned the word visual indicator. Anyone who wants to argue would make obvious sense that these are actually just technical indicators. But what we like to do is we go into the website, all the charts we have, and we kind of make visual observations of what happens when good things are happening, right? So if you look at the bull right there, you've got the price. It's above the moving average, the pink line. The pink line is above the purple line, which is the exponential moving averages. And when you have that situation, you've got growth. Generally speaking, when you look right in here, let me get my pointer out here. When we see this right here, that's growth. That's growth. Growth. We really like that scenario right there, even though we dipped a little bit below the MA line. That's really, really good for stock price, and obviously it shows that it is. Now, on the bear side, on the other hand, is when we reverse it. So here we got the price is below the moving average, and the moving average is actually below the exponential moving average. You also can visually see the slope difference. Here we're inclining, here we're declining. So what we have is, looking at different charts, we kind of come up with a grade, if you will, to say, okay, visually, how do these prices stack up? What is their slopes? And that then gets fed into the bear tracker as well. So a really bad situation might be something like this. If we got in this environment here, you may very well see that tracker move further and further to the right. So as I mentioned before, the bear tracker is a simplification of an overarching collection of indicators that just kind of give you an idea of kind of where we are. Is it things very dangerous? Is it very volatile? Is it very, the prices aren't where they need to be? Is there volumes, et cetera, et cetera? All those things go into play in order to calculate or to create what we call this bear tracker. Again, is it mean anything? Are we trading off of it? Of course not. But it certainly kind of gives us an idea to be kind of watch out, stay alert when we get into that higher levels. Okay. So that was kind of a feature called the bear tracker. As always, with this kind of algo trading, or any kind of hedge funds or other type of riskier investments, knowing there's some level of risk is a part of that understanding. Obviously, the higher the risk, perhaps the higher return, but of course, the greater the loss as well. And we do use leverage in this model, but I encourage you that the purpose of this channel, the purpose of the videos, is not to necessarily use our model, but maybe get you inspired to kind of build your own model. Maybe give you a watermark to go against. Can you beat the average rate of return over 33 years, 48%? So it kind of gives a watermark for that. Okay, well, that's all for today. Thanks for listening.